in seconds from now, and there you go. It's a good start for benchmark indices. It's a decent start for the market breadth, and a lot of green on the screen. Gland Pharma, Policy Bazaar, NTPC, Hero Motocorp. These are some of the newsmakers today. Gland Pharma 7%, Policy Bazaar of PB Fintech up 2%, NTPC 219 rupees, and Tata Motors is giving Hero Motocorp some company. So not a rara start for any of the big heavyweights, but there is a lot of green on the screen. The breadth, both in terms of small cap, mid cap, Cenexi, Nifty, all of them are now trading with a positive bias.
Okay, all right. So it's been a decent start, but let me just start with some of the laggards as well. Electra Green Tech is a results candidate, starts with a cut of around 7 to 8%. Ditto can be said for Rainbow Healthcare as well as Tata Chemicals. That's starting on the back foot as well. The street is not liking the kind of pricing pressure that entire vertical is going through. Paytm is the other one which has started with a bit of a cut, and Sobha Industries is also something on my radar. On the gaining side, we already highlighted Gland Pharma, which has done a stellar number. That's the reason Axis Capital has actually upgraded the stock all the way to add from a reduce. There's an upgrade coming in from Kotak Securities as well, and that's pretty much percolating in the stock price. BEML, which has bagged a 3,000 crore order for Metro, is higher by 5%. IRFC is chugging along nicely. You also have Indigo Paints, a result reaction. Policy Bazaar, as Nikunj highlighted, and then other names like Torrent Pharma, Sector also make it to the list. But the good news is all the sectors are trading in the green today. So metals may be on the bit of a back foot on account of that China data disappointing. But other than that, it's a sea of green, Aman.
Yeah, PSU banks, pharma, energy, they're all leading the way. Let's get in a take from Naresh as to what he makes of the market open. We're holding out convincingly above the 19,600 mark. Naresh, breadth in favor of the gainers. What is your first trade?
So the breadth is still in good state, but the market, the index has not moved up with a big gap up given the closing on US markets yesterday. So the view remains same, stock specific view. Continue like IndusInd Bank, that could be a stock which could take a move in leadership space in the banking.
Okay, Sridhar Sriram joins us, Investment Director with Enam Holdings. Sridhar, hi, good to have you back. Thank you for joining us.
Thanks for inviting.
How would you paint the scenario for us?
Our broad view for the market is that in the short term we could see a time correction or maybe a price correction, more from the fact that the macro data both in the US and in India, especially on the inflation side, still is looking a bit sticky. So for the US, I don't see it going below 2 at least in the next 6 to 8 months, and even for us to go below 4, I don't see it almost for a year. I mean, in fact, this month the number that we'll get for the previous month is going to be very scary. It could be well.
That's tomato and onion, no?
Whichever way it is. I mean, 50% of CPI is food.
Yeah.
And if RBI is going to look at only CPI for their rates, then that's what we have to worry about. It's a different debate whether monetary policy can really control food prices, but that's what we have to worry about, right? So I don't see any rate cut. I don't see a rate hike because of tomatoes. But I don't see a rate cut for at least for next.
Were markets betting on a rate cut?
I don't think so. I'm not very sure if the market's betting. So I think we are betting on a status quo unless this continues and RBI tightens not in terms of rate but in terms of liquidity. That could have some impact. But it does have an impact, right? I mean, if your interest rates are higher for longer, then it has an impact on the market. So we see it could be a time correction, or it could be some pockets where excesses are there. We could see some correction there. Worry will be more what happens in the US because just 7 stocks are holding the market there. The broader market hasn't done very well there. And the more you read how credit card interest rates have gone up, mortgage rates are almost 7.5, very close to where India is right now, and how that plays out, those will be the larger worries. I'm not an expert there, but whatever I read, it looks like it's a space to watch.
So if the US inflation is a concern, which in a sense is the biggest moving part, yields are at 4%, the peak yield in 2022 was 4.4, then why do you expect markets will be range bound with a time-wise correction? Why can it not be a slam dunk like a 10%, 15% sell-off?
So I take some solace from the fact that in March we saw a big crisis, especially in the US with the smaller bank issues that we faced there, and our markets held reasonably well. We did correct, but it wasn't like our banks were down 20% or anything of that sort. Many of the emerging markets had issues, like if you see Taiwan, Korea, they corrected very sharply at that time. We held reasonably well. So I would say India actually is sort of a defensive market. So if you see even for the current year, India has done what, 6-7% in dollar terms. Emerging markets are up 6-7%. And look at other markets, Korea, Taiwan, Brazil, all are up 15-16%. So I would say the defensive nature of India gives me the confidence that even if we see some sort of a crisis there, we may see some correction, but it may not be that sharp.
No pun intended, but you look at India as a defensive market, but in India, defense stocks are trading at consumer stocks. How strange is that, right?
We like that space. So
that's why I bought into defense.
Complaining at all.
That's why I bought defense.
Yes.
Why do you like that space? We've been debating this now. That look great big picture. I read a just flash which has hit my mailbox that the Indian government has now instructed Indian military that you even cannot use Chinese parts for the drone replacement. But defense orders are long cycle orders, 5-year, 10-year. You get an order to make an aeroplane to deliver in 7, 8, 10 years. Aren't markets pricing in too much here? Markets have started pricing these stocks like ABBs and Siemens of the world. Isn't there a disconnect?
So I think there's some disconnect in some stocks, but I would also want to highlight that the offset clause is also making a big difference. I mean, this has been there for many years that if we give an order to an overseas company, 30% has to be manufactured in India. That is being enforced only in the last 4-5 years. The impact of that we are seeing on Indian companies is huge.
And servicing the drones and servicing the planes.
Once you have the offset partner in India, then servicing of that equipment automatically comes into these entities, and we are seeing many of these companies seeing service income going up significantly. So apart from say the most intelligent part of say a drone or say a radar, which they may have some sort of the knowledge may not be in India, most of the other parts they are servicing. So I'm saying it's a whole ecosystem, the whole thing has changed over the last 4-5 years. So I think what the market is suggesting is good. Whether the valuations are right for today, I'm not sure. But if I extrapolate it for next 2 years and if everything plays out well, then there may be a story. So we are long some of these stocks. Some of them may not have earnings exactly as we expected. As you said, these are long gestation orders. Not all the orders are executed at the time that is expected. So there's some patience is required in this. But
where else are you long?
Financials, the very obvious one.
That's 2 years ago.
Yeah. I think, see, they have not participated. To be fair, the top 5-6 financials, if you see, they're up for maybe 5-6% for the year. They've hardly done much. Earnings have been very good. So I don't see complaint as far as earnings is concerned. Maybe margins have peaked out, but credit costs have behaved very well. So I don't think we are worried about 2 quarters here and there. We are seeing the longer picture or the next 2 years, 3 years. If India grows, say even at 6-7% from a GDP standpoint, these stocks have a long way to go.
So financials is the consensus trade, right? Consensus overweight. What's the most underrated sector as per you where you would like to make a contra bet now?
So I think contra bet, we've been long the PSUs generally. PSU banks, PSUs, and that trade has played very well. We are still very bullish on the PSU banks given the earnings. I mean, that's a segment where people, earlier there was a consensus negative. Now I would say it's a 50-50 where some people...
But even the lower order banks and not just the large bank SBI?
Yeah. So we're quite bullish on, there are just 4-5 banks investable in the PSU basket.
So should I start taking names and you will say no for them and yes for the ones?
Out of them, barring 1 or 2, the rest are investable actually. And they look reasonably good. Look at their earnings. I mean, they're still trading at 4-5 PE.
But why were NIMs were down? I looked at SBI and BOB, NIMs were down. Managements are saying that you hit a peak in terms of the credit growth. So if the business is not going to be in the expansionary mode, does it make sense just to look at value and then buy them?
So I think over concentration on NIM also is an issue. So what you have to look at is what is the operating profit growth. So you look at the operating profit growth is still growing at say 10 to 15%. Your credit cost is broadly stable or down. See, keep in mind that credit
ROAs
costs
are also going higher.
So you keep in mind that private sector credit costs have already come down substantially. They are at on an annualized basis 50-60 basis points. Most of the PSU banks are, barring SBI, most of the PSU banks are in the 1 to 1.5% range in the credit cost. that can still come down to say below 1%. So what you're seeing is your operating profit growth is say 15%. Your PAT growth is almost 50-60% even now. And that's coming predominantly because of this reduction that we are seeing in the credit cost. And we think that will continue to play. Some of these banks are trading at say 5% dividend yield now because they have to pay 20-25% of the profits as dividend. So, I mean, whichever way I see, it looks an interesting space. We think that a lot of the re-rating has already happened. From here on, even if you get earnings growth returns, that itself could be 20-25%. So, I mean, that's how I'm seeing it. Only time will tell whether we are right or wrong.
What about the entire auto space? For instance, we had the management of M&M right here in our studios yesterday, and they alluded to the fact that the premium end is seeing a lot of demand, and whereas the mid isn't seeing quite as much volume growth. Do you think that premiumization factor across the board, be it even autos, consumption, all of that is likely to stand out?
Yeah, so we are in the K-shaped recovery camp. We've seen right from say autos to watches to hotels to airlines to discretionary spending. Wherever you have there are pockets of discretionary spending, stay at the higher end, not at the lower end of the bucket. So we like all stocks in the discretionary space which are slightly at the higher end of the bucket, which is on the higher end of the K-shaped K. So I think it's playing out right now. We think it may continue to play out for maybe another year. Maybe closer to elections, we'll see some more dole outs and, maybe the post the monsoon, and if the rainfall is good and the crops are good, maybe things will change for the bottom of the pyramid. But right now, we prefer the discretionary at the higher end.
I haven't heard you speak about pharma at all. Is that a complete avoid for you? Whether
No,
diagnostics
actually,
or
pharma is a
hospitals?
very stock specific. Even now, if you take the top 5 pharma stocks, out of that 2-3 would have done very well, and you'll find 1 or 2 at the bottom. In terms of, even if you look at Nifty, you'll have top performer and the bottom performer in the top
Both
10. You'll
from
see
pharma.
pharma there. So it's very difficult to give pharma as a generic, and we don't talk stock specific, but we like some of the pharma stocks, especially on the large cap, where things are showing very promising growth in terms of the generic space and even non-generic.
You know, some of these new age tech companies, the results, really the proof is in the pudding. They're narrowing their losses, costs are under control. Does that change the case?
It does. So actually, in the last 6 months, we've been engaging with many of these new age companies, as we will put it. I mean, in 21, when they listed, we really didn't understand the valuation, the business model. And many of them didn't want to engage with smaller investors like us because a lot of the FIs were putting in money. Things have changed.
Small.
Yeah, I was just thinking smaller investors like you.
Things have changed now. I mean, they want to meet us and they want to discuss the business model. Also, the business model,
Which
to
is
be
this
fair,
company
has
which
changed.
does not want to meet an armed group. I want to find out.
It does happen. It does happen. No, but now the business models have changed. So if you see, all of them are talking path to profitability, and we can clearly see path to profitability in many of them. And we've changed our views and we've invested in a few of them.
Which ones?
We'll tell you after the show.
It's simple to look at where the matrix there is: financial services and consumer tech.
Yeah.
And so, consumer tech or financial services?
Both actually. Financial technology, we are clearly seeing path to profitability. Business models have changed.
Nikunj is trying to narrow down that list.
PayTM, Zomato,
Clearly changed.
PB Fintech.
But even on the consumer, in some cases the valuations are still high, but at least there is a business model which is.
How do you value them? Because there is no proof.
Yeah.
If you start looking at EPS, there is not going to be an EPS benchmark, even if they turn profitable.
Yeah,
How do you value them?
So you see, competitive dynamics in some of them, whether there are, how many players are there, how many people are competing, and try to figure out if required, can they turn profitable by charging more from customers. So I think it's at the end of the game, at some point it's more an art than a science. But at least the valuations have corrected. Earlier it was a complete art. You had no clue how to value them. Now I would say that there is some method in the madness.
They've realized that when you in the auction market, the rules are different. That's what I think promoter realization is, that when two smart guys are selling in the private equity market, valuations are different. When the auction market helps you discover it, the rules of the change are different. I mean, you cannot play volleyball in a cricket match.
Yeah,
That is what I think what has changed. When Manish Bhai was here, we spoke about manufacturing. And there is a lot of way in which you can look at manufacturing.
Yeah.
Pharma is manufacturing, EMS is manufacturing, auto ancillary is manufacturing. He gives this example that how when Maruti came, it created auto ancillary. When GE came, it created IT. Now Apple has come. What happens because of that? And then he stopped.
Yeah,
so why
I
don't you
think
take it
that's-
forward?
I think that's the crux, that EMS as a space, we think will evolve into a massive manufacturing opportunity for India. If Apple wants to export from 10 billion to 100 billion over the next 2-3 years, a lot of it may be in the private space, but it's going to create an ecosystem for the hub, the entire hub for manufacturing of, say, Apple phones. Now, today maybe only 10% is value addition in India, so 90% is import and you are just assembling. Over time, this 10 is expected to go to 40-50%. That's when the game changes. That if India starts to manufacture more and more parts for the iPhone or for the iPad or for whatever Apple is manufacturing and exporting. And we think that will happen. We saw that with autos also. That when we started in the 80s or 85, it was more an assembly unit.
Yeah.
And over the years, now I think almost 80-85% is manufactured in India. So we think that this is a space worth watching. Not too many
interested?
companies are there. I mean, today you're talking of 5-6 companies, at best 8,000-9,000 crore market cap. Some of them are even smaller. But over a period, we think that this space will, develop into a fairly significant opportunity for investors.
Are you Sridhar Shivram? Because you like banks, you like pharma, you like manufacturing, you like PSU, you like defense.
I don't like IT.
Oh, you don't like IT. Why is that? Now Sridhar Shivram is back. Why is
So
that?
I think IT is getting disrupted. I mean, this is my personal view.
of
Okay,
course,
we
of
have
course.
split view in our
Yeah,
office
of course.
itself.
That's how investing
So,
works.
yeah.
It's so beautiful if you look at the INAM and being an old timer market commentator, you know how things work. There are folks within INAM, they have a different view. There are folks within INAM, they're selling to each other. That's how I think markets are. Buyer and the seller,
Yeah,
they both think they are right.
Exactly. So
Okay.
my view is that Indian IT sector is getting disrupted by generative AI. 30 to 35% of the employees are in the 1 to 3 year experience bracket.
Just say that again. 30 to 35 is getting
Percent
disrupted.
of the employees are in the
1 to 3
years.
bracket.
So
Yeah,
they are
fair point.
basically the freshers who come in.
Yeah.
And Mohandas Pai has been very vocal about the fact that freshers in TCS and Infosys hardly get 4.5 lakh salary
Yeah, yeah.
per year.
2.5 lakh rupees.
So they are basically the coders, the low-end job that we are doing. We know that generative AI coding has become the easiest thing. What 10 people could do, 1 person can do now, and that too at a much faster pace. So what happens if the number of employees that tech companies in India they need is much lesser? If your business model is number of employees into time spent, which is how you generate your
Body,
revenues.
that's a calculation.
So your revenues are going to come down. The flip side is your productivity is going to go up. But my point is that if my client knows I'm using generative AI for some part, will he give me the same rate? Possibly not. So I think this is a space which will first get disrupted. There's also opportunity for AI, which is companies wanting to integrate generative AI into their business model. My view is that these companies first get disrupted where they will see slower and lower growth in terms of revenues. And then as they evolve their business model, we'll find winners from there. Whoever is able to disrupt and adapt better will possibly the winner. And a large part will see some sort of disruption. So what you should track is number of employees that people are adding. So look at Infosys. Last 2 quarters, they've had 12,000 lesser software employees. So if you take say 3,50,000 as the employee base, and out of that 25, say 30% is what I'm talking about. So that's like a 1 lakh employee base may already 12,000 you've reduced.
Yeah.
In 6 months. So that's almost like an annualized basis 25% reduction. I'm saying you cannot, I'm just
There is
giving a rough number.
There is a disruptive
Yeah.
element at play.
Correct.
Whether it's a tailwind or headwind, we'll figure it out. For right now,
this is my view that I think it is disruptive. Some others feel this is also an opportunity. But my view is that I would rather be on the sideline right now and see how this disruption plays and then take it forward when I have a clear view.
You
using ChatGPT a lot right
I
now?
do use,
Yeah.
in fact, I am also a photographer. I use Adobe and the generative AI and the improvements that have come because what I can do with on a Photoshop or on a Lightroom is
I don't even
significantly
think
gone
you
up.
need to go to the jungle anymore.
Still need to go for other reasons, but at least it's helping me in terms of process some of these photographs.
Yeah.
Well, so nice to have you.
Thank you very
And,
much for inviting me.
Thank you for joining us. What do we have in the market? After this very long engaging discussion, well, we've got a little bit of mid-air turbulence for Mahindra and Mahindra, a little bit of mid-air turbulence for some of the IT stocks. The breadth of the market is still holding on. Are we retreating again from 19,600? Let's see. Abhay Swami joins us now, Chairman and Managing Director with Max Healthcare. Abhay, good morning. Thank you for joining us. In Q1 FY24, while revenue growth was 20%, PAT was down quarter on quarter, mainly due to increase in employee cost and tax expenses. So since the company's expansion spree, should we expect higher cost going ahead as well?
So I think first and foremost, you're seeing a year-on-year increase of about 17% on revenue as well as 18% on EBITDA. You have to keep in mind that the first quarter is usually the weakest quarter in the year. So you have to compare it quarter by quarter. And the fourth quarter is actually the highest quarter in the year because seasonality is in the medical business. And that has been the case for many, many years now. So the right way to look at it is year on year. So I think year on year, you had an increase as far as EBITDA is concerned, and you had a flat, flat EBITDA as far as sequential quarters are concerned. So also you have to keep in mind that 1st of April is when we have salary increases, and therefore your cost structure increases on the 1st of April, and therefore you see a stress on your margins compared to the previous quarter, which is quarter 4, and which is the case which is played out here as well. Now, over the last 1 year, usually we have about a 7% increase in employee cost, in employee benefit cost, but I think it's about 8.5% this time, year on year. And that's largely because we've undertaken significant amount of projects. We've taken up, the new digital app that we've launched over the last 1 year. It's done very, very well, but at the same time, it's been really set up for very, very low cost. So both these, the digital cost and the project, reinforcing the projects team has sort of inched up the employee cost over the last 1 year, which is year on year. But if you see it actually quarter on quarter, the employee cost has not gone up so significantly. It's only gone up to extent of the pay increase, which is sub 7%.
Right, and your ARPOB has been good. It's seen a jump of 13% year on year. Is this looking sustainable? Is the company planning more price hikes? Because you did undertake one just in the month of April.
No, so we've had a 13% increase in RPOB, which is a significant number. Compared to last year, we also have a 3% increase in number of occupied bed days, etc. Do keep in mind, this is the 11th consecutive year-on-year growth quarter that we've had. So it's been 11 quarters of growth on a year-on-year basis. And, I think, that trend should sort of continue. So we've had an increase in RPOB. You see amount in increase in EBITDA per bed is also concerned. It is 70.4 lakhs in the first quarter of this year compared to 62 lakhs last quarter, and marginally lower in Q4 as well. So in spite of a weaker quarter, the RPOB is sort of held up, or there's been a marginal increase in RPOB. But, what you've seen is a number of occupied bed days, which has also gone up. Do keep in mind our capacity has gone up by about 4.5%. And therefore, when you see occupancy numbers, you see a marginal reduction, but in percentage terms only. In real terms, occupancy, because your installed capacity, your operational capacity has gone up by about 4.5%. Your actual occupancy has gone up.
Sure, point taken. But the other thing is that your share of institutional patients have been coming down. And if I have it right, the plan is to reduce it further with the new hospital additions, etc., that you have planned. Where do you see the contribution of institutional headed, let's say, by FY25?
So I think if you actually look at the total number, it has you see a 18% number, but whereas I see a lower number, and it's simply because, like I said, we've just opened up another 122 beds in Shalimar Bagh, where because these are brand new beds, you first try to occupy the beds. So in that particular hospital, we've increased occupancy of institutional business. But that particular hospital overall has come down significantly lower. So amount of occupied institutional beds, which was I think about 28 or 29% in the previous quarter or previous year, sorry, has come down to about 26% in the current quarter. We've guided to the fact that we see it coming down to about circa 15% occupied beds for institutional business over by 2025.
Okay. Now in Q4, you commissioned 92 beds or a 92 bed oncology bed, I mean largely for cancer care, in the Shalimar Bagh. How is the occupancy there, and can you share operational numbers of this unit?
So very good question. In spite of that capacity in Shalimar Bagh going up by 40%, within the first 1 month, the overall occupancy of that hospital was about 76%, and it continues to be that. The EBITDA margins on the incremental beds, so not only broke even, but gave a 40% EBITDA margin compared to 28% for the rest of the network. So we've seen immediate catch up of that new capacity as we had guided previously. Not only that, huge amount of operating leverage kicks in on these new beds because the subsisting or the prior capacity already has the fixed costs of management as well as senior clinicians in it. That is also something we had guided to. So within 30 days of those beds opening, like I said, not only were those beds occupied, but were giving a operating or a EBITDA margin of 40%. And that's what we see going forward. And that's the wonder of brownfield projects, because essentially you're putting it up in lands which are adjacent to existing hospitals which are run out of capacity. They're already incurring all the costs. And so therefore, when we kind of open these new beds, we tap into, huge waiting periods that we already have in existing hospitals. So, I mean, we are doing brownfields, we're only doing expansions in locations where we are operating at about 80% plus capacity in any case.
Right, and can you update us on your expansion plans? I believe you plan to add over 1,500 additional beds by FY25. What can we expect for FY24? And are you on track to commercialize the 300 beds at Dwarka by Q2?
No, so we were expecting commercialization by October, November. That is something that we had guided as far as Dwarka is concerned. That should be in line. Maybe 30 days, 40 days up, down at that stage, depending on those final permissions, which need to come in, including nursing home license, etc. But I think it's pretty much on schedule. If I look at my overall capex, our overall capex is at a cost of about 4,500 crores over the next 4 years. We are generating, last year for FY23, we generated close to about 1,280. That's almost 1,300 crores of free cash flows. So we should be able to, and a lot of this capital expenditure is back-ended because that's when you kind of do the finishing and you buy the medical equipment and everything. While initially what you're doing is superstructures, which is a fraction, which is literally 1/3 of the capital cost. So we expect to do this entire capex through 50% of our internal accruals. We have cash on our books, and we intend to use this as well as the balanced internal accruals, as well as a balance sheet, to be honest, because we also guided to the fact that we will lever ourselves up a maximum of 2.5 times debt to EBITDA. So we'll be using all of that for acquisitions M&A besides our capex plans.
On that note, we let you go. Thank you so much for joining us with that quick take on the earnings. But from one management to another, Mr. Sudhir Sitapati, the MD and CEO at Godrej Consumer Products, joins us on the show. Hi, thank you so much for making time and speaking with us. I just wanted to begin by asking you that this is the second consecutive quarter of double-digit volume growth. Is it safe to say that the worst is behind and this double-digit growth is likely to be sustainable for FY24, both in terms of volumes as well as revenue?
I don't think double-digit volume growth is the trajectory that we will be on for the next couple of quarters. I think, it is fair to say that our trajectory will be higher than the trajectory it has been in the past. But both this and last quarter were good quarters, aided a little bit by weather that was conducive to household insecticide sales. So I think things are looking good on a longer term basis, but these 2 quarters have been optically better than what we anticipate quarters in the next few quarters to be.
The rural accounts for 30% of your total sales. What is the growth in rural versus urban, and if you could quantify that for us?
Rural business continues to do a little weaker than it was doing pre-COVID. It is now growing around roughly at the level of urban. Prior to COVID, rural was growing significantly faster than urban. So rural is not quite the kind of tailwind that it was in the past. And really, it's more equitably spread between urban and rural, the volume growths.
The home insecticide segment as well has witnessed double-digit growth. How much of that is due to the beneficial weather conditions, and do you think that this growth within the segment is sustainable?
I mean, some of it is because of beneficial weather conditions. Some of it is because of innovations and advertising. This is a category that fluctuates based on seasons. And just as we have some quarters in which we have poor household insecticide results due to weather, this one has been the opposite.
Sudhir, I also wanted to talk about the EBITDA margins. It was a very strong show this time, at least when it comes to the India business. But the question is, will you have to part with some of these EBITDA margins that we are seeing, and it will go away on account of higher spends in marketing, etc.? What's your take?
Oh, I mean, I don't think I think the EBITDA margins have recovered to our historic EBITDA margins, albeit with a very different shape of P&L. Lower gross margins, higher advertising, lower costs. I don't anticipate EBITDA margins unless there is some hyperinflation cost, in which case we have some principles of not passing it on to consumers. But that is not what we anticipate going forward. So we anticipate EBITDA margins to kind of roughly be where they are, or maybe slightly improve.
Growth in Africa has been for 2 quarters due to devaluation of currency. Have things normalized? Could we see continued weakness there?
No, I mean, I don't think I think the Africa performance has been good in the past quarter. The way to measure the Africa performance is, cash flows and volumes, both of which have been quite good. In the subsequent quarters, there's been a very sharp devaluation of the Naira. Some of the devaluation has been optical, where the parallel market rate and the real rate have now kind of converged. So there will be some optical changes in the P&L, but this should not affect either underlying volumes or cash flows.
Now, Indonesia as a region is returning to growth. So what is the difference between the primary and secondary sales now, and are margins looking sustainable?
The Indonesia business has had a good recovery, despite the fact that even in this quarter, we have continued to downstock in modern trade. Despite that, we've had a good quarter. So our secondaries are ahead of our primaries. This augurs well for us in the next few quarters as well. I think the good thing about Indonesia is the Indonesian macros are looking good. Our own processes and business is looking good, and our market shares are looking good in Indonesia. So our prognosis on Indonesia is reasonably bullish going forward.
Okay, so bullish on Indonesia, that's the word coming in. But Sudhir, the capex that you outlined in terms of your commentary after the earnings, how are you going to fund this? And secondly, which product lines will you be prioritizing in the order of the capex that you're going to undertake?
I think the purpose of our capex is threefold. First is we anticipate volume growths to be pretty high in the next few years, as they've been in the last few quarters. And we need capex to fund volume growth. Secondly, we need to get our manufacturing footprint to be more efficient in terms of logistics. And thirdly, we need to increase our automation so that we can reduce our conversion costs. So these are the three drivers of our capex plan. Our capex proposal is about 900 crores over 3 years, which is doubling of our existing capex rate over the last few years. We can pretty easily fund this from our operating cash flows.
Okay, Mr. Sitapati, on that note, we'll let you go. Appreciate you joining us on the show. Let's take stock of what's happening in the market because there has been a bit of a let up from the highest point of the trading session. We are in the red now, 19,586. It's Bank Nifty which is doing okay and the broader market is holding up okay. But Nikunj, this is exactly what we were talking about, right? That entire sticky zone of around 19,600, which is a bit of a hurdle.
So you got to be patient now. I mean, investing is not that you come and you get a daily appreciation on the NAV. I think sometimes you look at the recent performance, you suffer with what is called as recency bias, which is that what has happened in the past will happen in the future. When you have a loss, you think that gains will never happen. When you have gains, you think losses will not happen. Last 3-4 months may have spoiled you in terms of the expected returns for equity markets, but I think we could be getting into what is called as a slumber mode. What is a slumber mode? You will get kicked here, kicked there, nothing wrong globally. If something changes globally, then we are looking at correction, which thankfully last week did not change. But I don't see a reason why you will see a lot of momentum on the upside. Similarly, I don't see a reason why you will see a lot of pronounced momentum on the downside. You may just get kicked here and there, just in a narrow, tight range of maybe 500 points in the Nifty. That's my sense.
Just wanted to bring up the dual chart of the top gainer at the index and the top loser almost. That's M&M as well as Hero MotoCorp. Even Eicher Motors is down. Nikunj, what do you make of this? Hero MotoCorp up 3%. Of course, that sales figure that we saw is quite solid despite the price point. Eicher is on the back foot and so is M&M. Do we have a new leader in the pack?
See, M&M, I think from an RBL standpoint, the concerns are rested. They've said that it is more like a 400 crore, and I hate to use the word, but they are calling it as 400 crore lab experiment. I can argue about the spirit of it, but it is not something which is going to be really changing the fortunes of Mahindra and Mahindra, where they are very clear that, look, we will not deviate from the path of our capital allocation. Then you got Hero MotoCorp. Hero MotoCorp, frankly, in my book, has disappointed more in last 3 years versus has surprised us. Can they get this entire Harley bike right on track? But it is not going to move the needle for Hero MotoCorp. They have to get exports right. They have to get the domestic entry level 120cc marketing positioning right. Then you have Eicher. Eicher's dominance has not been threatened up until now. But just because it's not been threatened in the past, will it not be threatened in the future? That time will only tell us. But every time we made a case that launch from TVS, a launch from Mahindra, a Java launch, a Harley launch, they'll have impact on Eicher. Well, Siddharth Lal and his company have surprised us. So only time will tell us which way things are moving. But for now, yes, because of the new booking numbers have come out from Hero MotoCorp, it's a cheap stock, numbers are not out. I think there is a deep swell today. I will not read too much beyond that.
Okay, 2.8% on a Hero MotoCorp, and yep, that is M&M, which is lagging in trade today. But let's move right on then. Capri Global in the spotlight on the back of earnings. Rajesh Sharma is the MD and CEO who's waiting by. Good to have you on board. Let's begin by talking about your net interest margins at a 5-quarter high. Now, while your spreads have improved and your margins have been aided by the equity funding, question is, going forward, is this sustainable?
Yes, so if we look this net interest margin increasing on account of the new product of the gold loan. Now gold loan AUM is growing and we already have about 700 plus branches in the gold loan. So the more mix of the gold loan overall AUM increases, the net interest income as well as net interest margin will keep improving.
Now that interest rates, Rajeshji, have pretty much peaked out, your asset liability mismatch, your cost of borrowing changes. So what happens to a model of NBFC and a Capri model when from a rising interest rate environment we move towards a benign or a stable interest rate environment?
So interest rate hike has an impact on cost of fund, and what essentially happens that we are not able to pass on the entire cost. So they are having some pressure on the margin of all NBFC and housing finance company. Once the interest rate stabilizes, the new lending, what we are doing, that interest rate will be passed on. Then the past portfolio you are not able to pass on because 50-60% portfolio of NBFC remain the semi-fixed region. So if the interest rate remain flat, I think there will be two impact. One, the new incremental lending will continue to happen at the maintaining the same spread. And number two, the cost of fund will stabilize. So that will also impact that our margins will be stable.
Okay. So let's say your AUM growth is 60%. I'm assuming that this would include the gold loan also. But if you have to strip out the gold loan and look at the traditional business, what is the AUM growth? And can you also separate gold versus traditional business for us?
If we exclude the gold loan growth, then our MSME, home loan, other businesses, the quarter one would have been 38% higher. So growth would have been 38%. In past, we have given the guidance of 30%. So in any case, it is higher than that, even excluding the gold loan. And if you talk about the gold loan, the March, it was 1100 crore. Now it is about 1500 crore. And the year end, we should close about 3000 crore in the gold loan AUM alone. Overall, AUM, we are achieving, trying to reach a base of about 15,000 crore by the March end, giving about 40% plus AUM growth.
He has approved issue of equity shares on preferential allotment basis to Suzuki Motor. This is new. I don't think this has been part of any kind of buzz or any announcement. This is not historical. This looks like it's a new announcement which has come in. We'll try and get more details at what price. The fact that Suzuki is looking at increasing their stake in Maruti and it's a preferential allotment which has happened.
So Nikunj, I think this is with respect to that plant that they're taking over in Gujarat. Remember, they announced it with the earnings that they're taking over that entire plant from Suzuki. So as a consideration of that, they're doing a share swap on a preferential basis. So the valuation wasn't out yet. The consideration wasn't known at what value they're going to take it. We still don't know that because they haven't disclosed the price as far as the release goes. They have given some data in terms of what the actual swap is in terms of basis of PAT, EPS, but it's a very complicated number, to be honest. What we know so far is that they are going to do it in terms of a share swap. It's not going to happen on a basis of cash consideration, but the exact swap ratio and which side does it really favor, we'll have to wait by and get more details. So that's the latest coming in on Maruti Suzuki. This is the consideration that they are paying on account of that plant that they are taking over in Gujarat. But let me come back to the conversation that we are having with the management of Capri Global. Just wanted to get a sense from you that Q1 was on the weaker side, at least when it comes to disbursements, because that's a seasonally weak quarter. Going forward, what's the run rate you're expecting in the next coming quarters and any internal AUM target that you have in mind?
And overall, AUM growth will be happening 40% plus, and I think we are aiming to achieve a AUM by the March about 15,000 crore. And internally, as you said, Q1 is always the lowest. I think Q2, Q3, 4, and Q4 is the last one higher. So I think gradually we will see that our AUM growth will be happening. So this quarter, coming quarter, I think we will be targeting again on quarter sequentially about 12% AUM growth.
Do you see this kind of a trend for Capri Global to continue for 2 or 3 years, irrespective of this whole element of state elections and then general elections next year?
So if we believe that democratically the election is one of the very big event and big festival in one way, and a lot of spending happens in the rural and side, and we have seen historical that whenever the year the Lok Sabha election happens, the credit demand goes up, even collection efficiency we've seen it is dramatically improves. So I think that year itself, it is in some way percolate a lot of orders, a lot of new business, a lot of demand from the MSME side. We clearly see that the election year is not it is a good year for MSME and housing segment as well. So election will not have any impact, the negative, it will have a positive impact as such. And if you look for our growth side, even with the higher base, we intend to add another branches. Now about 849 branches are operational. We'll add another 200 branches in the coming year. With the backdrop of the growth, demand and our branch expansion, we see that in next 2 to 3 years, we'll continue to have 30% plus growth in AUM easily achieved. We have already provided the equity by raising the rights issue about 1440 crore rupees. So we currently are about 40% capital adequacy. And we are able to access the liability side easily from our banks. So overall, everything is in place. So I think we want to be part of this India growth story where we are keeping a target of 5 trillion economy. I think in that itself will release a lot of demand for MSME and for the housing growth.
Okay, sir, on that note, we let you go. Thank you so much for making time and speaking with TT now. Quickly, in terms of the market, what's buzzing around is the entire auto sector, both on the upward trend as well as the downward trend. So Hero MotoCorp higher by 3%. You also have M&M as well as iShares on the back foot. The other one that we're watching out for is the pharma sector. So Cipla, for instance, is up around 2%. Dr. Reddy's is doing okay. Can't take your eyes away from Gland Pharma because that's managed to report a stellar set of numbers. Quite a few upgrades coming in, and the stock is reacting positively to that, 17% higher for that one. But let's also welcome on board Mr. Baman Rustam Irani, the CMD at Keystone Realtors, to talk to us about their numbers as well. Baman, hi, thank you so much for making time and speaking with ET now. It was quite a stellar quarter, at least in terms of pre-sales, which came in at an all-time high level, despite Q1 being a seasonally weak quarter. Is this on account of some new launches that you undertook, or is this something which is going to be the run rate going forward?
Right, thank you for having me on the show, and very happy to be here. Yes, it's been a stellar quarter. We've had 502 crores of pre-sales, new pre-sales. We've had close to around 495 crores of collections. What's very important is that we've created an operation cash flow of about 110 crores. We've launched 2 new projects with a GDV of about 890 crores. And added 3 new projects to our development portfolio, which will be having a GDV of about 2,500 crores. Given the fact that we had been preparing for this for quite some time, as you're aware that Keystone Realtors has been in the business, Rustamji has been in the business of redevelopments. And redevelopments are something that's a continuous working cycle that we take. We've been very successful with our launch in Thane, where we sold about 122 apartments in less than 45 days. And the market is extremely strong for the kind of products that we are building. Our team is extremely well geared up. We are well capitalized. Our net debt is 0 at this moment in time. And we have a firepower of 500 plus crores to be able to make new acquisitions. And we are well on our way to perform the way we had spelt out in the market earlier. 1 new launch every quarter this year, and a similar number of OCs that we will get for our products that have been in the pipeline. So yes, it's been a stellar quarter, and I must congratulate my team entirely. And thank you very much for having me on the show.
Hi, Baman, Avan as well joining in. So given the fact that you're sticking to all of that guidance, you had also spoken of a pre-sales growth of 25% year on year. Given that the momentum has been healthy, are you looking to revisit that or are you sticking to this guidance? And can you just highlight for us how much of the pre-sales growth has been led by volumes and how much by pricing?
So Aman, thanks for that question. Look at Keystone Realtors, we've been very focused on a 25% growth, as was mentioned earlier. If the growth should be more, we will be only too happy, but otherwise, all efforts are being made to stick to the 25% growth this year for pre-sales. You asked about volumes. I just mentioned that we were pleasantly pleased with our marketing and sales outlook, where we achieved about close to 122 sales in Thane in under 45 days. That's almost 3 apartments a day, which is very, very strong. Our volumes are up by 46% in terms of sales this year. And yes, you will see a further growth going forward, but it's better to maintain the 25% growth as the prediction, and then try and outperform the markets, because that's what I understand everybody loves.
I just wanted to scratch that point which you said in the first answer about redevelopment, because growth of late has been pretty much fueled by these redevelopment projects itself. Are you looking at making some fresh launches as well, or going forward the focus area is going to be just redevelopment projects? And within that as well, is there any particular micro market that you are targeting?
Wow, thank you for that again. At Keystone, we are data driven. We follow the infrastructure growth. And over here, a big kudos to the government. They've been investing heavily in the infrastructure of MMR and Mumbai, which is going to add to better the lives of the residents of our city. The micro markets that are absolutely strong for us are the western suburbs. We've seen a great amount of growth out there, whether it is in the mid-mass, which is 1 to 3 crores, or the aspirational, which is in the 3 to 7 crores. And when I talk of these markets, they're everything between Borivali to Andheri being the mid-mass growth, and aspirational being everything from Andheri coming up to Bandra East. Bandra West has been leading our premium segment. At the same point of time, our project in Prabhadevi has been seeing a lot of interest from the consumers that have come over there and evaluated it. And we're very happy to state that redevelopments, which is going to be the huge supply side for the city is where Rustomji has been working for the last, I would say, 23 years. We started in the year 2000, and we've created a proper SOP on redevelopments. We kind of understand what exactly the people that are going in for redevelopment want. We are able to pre-assess which areas to go in for. We are able to pre-decide what kind of issues will come for that. And our go-to-market strategy is extremely well crafted. Between getting the LOI and going in for a launch, we are anywhere between 12 to 15 months, depending on the size of the project, with all approvals. And when I say go-to-market, means with RERA approvals and a launch. And over here, I'd like to just state that we have, again, a very strong philosophy in place. We do not invest more than 10% of the GDV of a project before its go-to-market. And that means after that, we are ready to launch, and sales will start supporting it. And we study the micro markets that we are looking at. We will foray into the city, that is into the center part of town. Again, that is something in next year.
Yeah, indeed. The redevelopment market is really poised to grow strongly. Just wanted to understand from you, what has changed recently that developers are finding that JDA, JVA options a lot more attractive as against what we've witnessed a few years ago?
I think everyone is beginning to see the light, Avan, in terms of asset-light models, which is something that we at Rustomji have been literally working all the time on. Real estate being a business that is, prone to risk. We have a very good risk mitigation strategy. We have an internal IC that kind of holds us or gives us guide rails and doesn't allow our entrepreneurship to become, or rather allows our entrepreneurship to actually become something that is useful for the company. So whenever we are assessing a project, we put it across to the IC, which includes our CFO, our directors sitting on. At the same point of time, we always make sure to have one external voice, whether it be a banker or a developer from another part of the city, to sit in over there just to see what are the blind spots that we could not be looking at. And this has served us well, and going forward, we'll continue to grow this practice.
And Baman, before I let you go, just wanted to understand in terms of the dynamics of the city right now, in terms of supply demand, how's that shaping up? No impact of all that interest rate hike, etc. Are footfalls converting into actual sales at the same momentum as earlier? And pricing for the rest of the year, how do you see that panning out?
There's definitely a very strong demand for the housing in the sectors of mid-mass, which I have mentioned, which is the 1 to 3 crores. And we've seen a steady, strong growth in that segment. At the same point of time, wealth creation in the hands of most of even the salaried classes is making sure that the aspirational class, which is the 3 to 7 crores, is also growing strong. And towards that, we've been observing that the kind of buyers that we are interacting with and the kind of product that they're looking at is something that will keep us personally as Rustomji going strong in their minds. And our full kudos to our marketing and sales team for being able to assess the kind of product in the particular micro market that we're launching in, and be able to even predict a price line and a sales volume that we can achieve in time. So this is a lot of internal research that goes on at our organization. We are very focused on the markets that we are in, and turnaround times have been good. And we've maintained a strong, steady rate, which allows our consumers to have a greater amount of faith in us.
On that note, we'll let you go. Appreciate you joining us on ET now, and best of luck for going forward as well. But shifting focus to the new kid on the block, and this one is NIIT Learning Solutions. Remember, this is the demerged arm of NIIT Limited, and this one is going to focus on corporate learning business. Of course, this is that bulky part of the business as well that the company has been generating, because the net profit of this vertical in the year gone by was around 200 crores. The revenue was up around 20% in FY23 by around 1360 crores. When the company had gone X, in terms of the adjustment of price, the stock was actually down by around 310 rupees thereabouts. So the derived value of this stock was close to around 310, but it's managed to list around 360 thereabouts, telling you that there is a bit of a momentum build up. So though of course after that listing it's been a bit subdued, but holding out around that 365 mark. The big question is, what do the roadmap ahead look like? Because in terms of growth, it's been doing okay. Will it be sustainable in the environment that we are in? That's a big question that we'll be posing to the management when they join us at around 10:30. But from the broader markets, what else is happening? Well, Gland Pharma, that one is locked in upper circuit now, 20% higher. RateGain is seeing quite a bit of momentum right now, 11% move coming in there. Captain Point is the other one, which is 9% higher. Adani Green is seeing a move of around 5%. Angel One is also in the news. On the losing side, it's Graphite India down 5%. Electra Green Tech has also taken a knock of around 5%. And you also have MedPlus and Policy Bazaar, which are on the back foot. I think it's a good time then to take a breather on the show and slip into a very short break. Don't go anywhere, because when we come back, we'll have a whole host of other managements and stocks to track as well.